Today we're going to talk about why rent is so high in this country. In the last 5 years, from 2017 to 2022, rent went up by 5.7%. But the pandemic changed everything because from 2021 to 2022, rent went up by 14%. And the highest increases came from the East Coast in states like Florida, Tennessee, South Dakota, New York, and North Carolina. And it gets even worse if you live in a major city like San Francisco, where the median rent for a one-bedroom apartment, something that looks like this, goes for $2,950 a month. A comparable one-bedroom in New York City goes for $3,690 a month. Over the last 2 years, rents have gone up by $302 monthly, or 9.2% per year. Now, just for context, the average should be closer to 3% in a healthy economy, not 9%. So why is this happening? According to a report by Moody's Analytics, which is a company that's been studying and looking at rental price growths over the last 20 plus years, they say that the US is now what's called rent burdened. And that's thanks to what's called the RTI, or the National Average Rent to Income Ratio. In other words, how much money you pay for your rent versus how much money you're making. Now, the general rule of thumb is when you're looking to rent or buy a house, to plan on never spending more than 30% of your income on those monthly payments. But what they found was mind-blowing, because going back 20 plus years ago, they discovered that people were spending closer to 1/4, or exactly 23% of their income on rent. But fast forward to today, and people are spending almost a third, exactly 30%, if not more in some cases. And keep in mind, these are the average numbers. We're not talking about major cities like Miami, where people are spending closer to 42% of their income, or even New York City, where people are spending an astonishing 68% on their monthly rent. Now, if we fast forward to the latest data, January 2023 national median rental price is $1,942 per month. Now, that is down from the peak of where it was in August of 2022, when rent reached $2,053 a month. So yes, rent is now lower, but it's still way too high. Why is this happening? What the heck is going on? Where are rental prices going this year, and what can we do about it? That's what I want to talk about and explain in today's video, so let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance, and let's just get right into it. So the most important question we have to answer is, why is rent so expensive? And according to the Housing Affordability Index by the National Association of Realtors, this graph right here shows us that the height of the pandemic was the most affordable time to buy a house. Go figure. At 100, that's the benchmark. That shows where incomes need to be to support buying the average house. Now, if it drops below 100, like for example, if it goes to 50, that would imply that homes are twice as expensive as incomes need to be. Now, if we go above that, that's obviously more affordable. Where we are today, though, is just barely above 100, which means homes and just the average house is barely affordable for the average person. Now, there's a lot of reasons why things happen the way they did, but here's the explain it like I'm 5 version. To save the economy from total collapse, the government introduced relief programs and stimulus checks, and the central bank lowered their interest rates to 0. Couple that with high inflation, and it made a lot of sense for a lot of people to buy a house, especially as we all learned we might be staying indoors for a really long time, so we might as well enjoy our prisons. This had a massive impact on the supply of housing, which skyrocketed the value of the average house. Now, last year, as interest rates went up, the value of the average home didn't go down by as much as people had expected, and that priced a lot of people out, forcing them to become renters. Couple that with institutions and hedge funds looking to make a return on their money by buying single-family homes, and you get a perfect recipe for the difference in income growth and rental growth rates to get wider and wider. And as people have to spend more on their rent, they have that much less to save for a down payment to buy a house. Couple that with these higher interest rates, and that's why we saw the spike for rental prices. Now, this really blew my mind, because in 2021, you needed to make $76,000 per year to afford the average house. But fast forward to today, and you need to make over $100,000 a year just to buy that same house. And that's kind of crazy to me, because making 6 figures a year is now not even something to strive toward. It's almost a requirement just to buy the average house, unless you want to rent, which according to Realtor.com right now makes more financial sense to do in 45 out of the 50 largest metro cities, with the exception of cities like St. Louis, Memphis, Birmingham, Pittsburgh, and Baltimore. And even though the supply of housing is going up and demand is slowly coming down, the supply is still below what it was before the pandemic. And supply and demand plays a huge role in dictating those prices, but so do incomes. And right now, we have the lowest level of unemployment since 1969. And that's because there's far more jobs than there are workers, and that's why incomes went up 5.1% in 2022. It's not enough to keep up with inflation, but it's still enough for people to pay down their homes and build up equity. And that's why roughly 85% of homeowners today have a mortgage rate that's below that 5% interest line. And that's partially why we're in short supply. And it makes sense. Why would anyone want to sell their house today if right now homes are slightly overvalued and their interest rates they're getting are 6.5%, when just last year, this same time, we saw interest rates at 3.25%. Sellers don't have as much of an incentive to sell their house right now unless they absolutely have to. But there's also a catch, because the data that's in the CPI, the Consumer Price Index, which is what measures inflation, that shelter index isn't accurate because it's backwards looking. Think about it. As consumers, we don't sign a one-year contract to pay the same prices for 1 pound of chicken. We just pay whatever we pay. But that's a unique thing to shelter because we typically sign those contracts in terms of 1 year. So it's taking us a while to have that rent data come down. In reality, rents have come down, but the data just hasn't had the time to catch up just yet. According to the S&P CoreLogic Case-Shiller Home Price Index, which is just an index that tracks the top 20 metro areas, it shows that the average house price is down 6% from its peak in June of 2022. And this also makes perfect sense because it was the areas that experienced the fastest growth rate in 2021 that are now seeing the biggest correction. Now, nationally speaking, the average house price is down 3.5% from its peak, and rental prices are trending down as well. This blue line right here shows that rental rates are trending downward, but they're still going up, just at a slower rate than they used to. And the idea, this inflection point that we see at the top is gonna hopefully continue to go down until we stabilize somewhere between the 4 to 6% range, which is where it should be in a healthy economy. Whether or not this trend continues to go down is not something I can predict because I'm not a real estate expert or professional, and at best, I can only look at data from the past and try to understand and explain it, so I think it's anyone's guess. But at least as far as the data that I saw, it seems like rental growth rate will come down, but rent prices themselves will most likely stabilize at a level that is somewhere higher than where it was before the pandemic started. Now, I think the more important question that I'd like to answer is, what can we actually do about it? So there's a couple things, and one of those things is just to wait to buy a house. If it makes financial sense now to buy the house, then go ahead and buy it, but maybe wait because your credit score could be going up soon. The 3 credit bureaus that make up your credit score, Experian, Equifax, and TransUnion, will stop reporting any medical debt under $500 on your report. This just means if you owe less than $500 in medical debt, that will no longer negatively affect your credit score. Now, this does not mean that it's forgiven and you shouldn't pay it back. You should still pay it back in full as soon as possible, but going forward, any new medical debt that you incur will take 1 year to appear on your credit report instead of the 6 months like it used to. Hopefully this will help you boost your credit score and you can get that better rate. But actually, let's just never pay any of our debts again. Not mortgages, not auto loans, not tuition, not credit card debt. Let's just stop forever, and instead, let's vote to increase our debt ceiling. And if we can't get the politicians to agree to that, let's just not show up to work. But Andre, that's irresponsible. No, Dave. It is the American way. No, but actually, believe it or not, that's exactly how the national debt works. Right now, the US owes way more money than it'll ever be able to pay back. But rather than be financially responsible and try to get rid of the budget deficit and pay back our loans, instead, politicians just sort of debate with each other every once in a while to increase what's called the debt ceiling. And if they can't come to an agreement, they just don't show up to work. Why can't we do that? I'm just kidding. Don't do that. Do the exact opposite. And on that note, try to pay your rent on time because that gives your landlord less of an incentive to raise their rent on you. And also, this is something I've done for as long as I can remember, which is to get a roommate. I've lived with a roommate now for close to 5 years, if not longer. So the more roommates you have, the less enjoyable life will be, but the more money you'll have. Half kidding. Obviously, live with people you like, live with your friends. Otherwise, Not kidding. Tip 3, check out the rent versus buy calculator from the New York Times. It's an incredible tool, and I know that buying a house is an extremely emotional thing to do, but when it comes to money, you should just know all the facts. I've made a video guide on how to use it. It's a completely free calculator. The video is free, so please use that resource. Also, try to make some extra income with a side hustle, and if you're out of ideas, just ask ChatGPT what it thinks, or check out my 6 side hustles to make $100 per day video. Long story short, if you don't go watch that video, try doing Airbnb with the permission of your landlord. I was able to do this and pay for the majority of my rent, even though I didn't own the house. Another pro tip though is eat ramen noodles for the rest of your life. See? There's a lot of creative ways to cope with being a millennial. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. Links are down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.